Production expenses were forecasted to be at record levels this year, but could a new year bring relief? I'm Michelle Ruck. Clinton Griffiths is on assignment at this year's Milk Business Conference in Las Vegas, and we'll hear from him in just a bit. In 2025, production expenses were projected to be at $467 billion. That's nearly $12 billion higher than last year. I recently spoke with a team of experts about whether the trend will continue into 2026. As farmers plan for the 2026 crop season, input price inflation persists, even in the face of lower grain prices.
Input prices are not falling at the same rate as commodity prices are falling by any means, which is not historically normal, right? Generally, the charts work together, right? Pop up, pop down.
It's just kind of death by a thousand cuts. Costs are increasing everywhere you turn, and we don't have the ability to pass that on.
It's being driven by geopolitical events, and the trade war also had China importing less pesticide ingredients and fertilizer products to the U.S.
A lot of the tons that are in place, still very tight supplies. Demand is better this fall than what we have been expecting to see. So nearby S&D is very snug.
The National Corn Growers Association has a task force looking at high input prices and the impact that's having on profitability.
We're looking at, $170, negative margins in corn this year, which is pretty dramatic. And when you add that to, a couple of the peripheral states where they've had disasters in the last 2 or 3 years due to drought, the growers in a pretty tough shape right now to endure some of this.
He says in response, some producers may leave fields idle for 2026.
If we keep this input level and our negative margins are where they're at, it's cheaper for us just not to plant the crop and forgo the land costs that we would endure.
Ag bankers say the squeeze is showing up in balance sheets.
High input prices, low commodity prices squeezes margins and really makes it hard to be profitable.
And while it's not a crisis yet, he says stress is building.
We are seeing with our surveys, when we talk to bankers right now, that they believe 50% of their producers will not be profitable next year.
So without a drastic change, some producers may go out of business.
There are some deep losses that have been incurred, and it's been piling up over a 2 or 3 year period.
But ag bankers are working with farmers to get loan renewals to buy those higher inputs and stay in business for 2026.